Well, as the earnings season juggernaut rolls on, what we are looking at this point of time is that quite a few brokerages have actually done a mid-quarter check or a mid-earnings season check, and seeing how markets are placed relative to the earnings velocity, the commentary that is seen, and also a lot of them have been forced to actually go ahead and tweak their EPS estimates both for Nifty companies as well as the target prices for the Nifty. Citi has come out with a very interesting note. What they're saying is that so far earnings have actually been significantly ahead of what the markets have been estimating. So 40% of the Nifty companies, if you're talking about it by the weightage, have reported close to a 10% year-on-year growth, and the EBITDA is up almost 20% on a year-on-year basis, mainly on the back of the fact that number one, you're seeing growth kicking in, and number two, you're actually seeing a significant amount of cost controls that are seen both on a year-on-year basis as well as on a sequential basis. One of the important things as per Citi to keep an eye out for is the festive demand. Now, festive demand, one of the key indicators is the auto pack, and the auto pack, what they are saying is that initial data points as far as the two-wheeler sales are concerned is pretty sluggish. However, what they're saying is that the passenger vehicle sales data is something that is looking quite strong. So what they are saying is that they've gone ahead and raised their September 2021 Nifty target to almost 11,700, and one of the main rationale for this particular increase as far as the Nifty target is concerned is that they believe that with economic activity normalizing and also earnings holding up pretty steady, they believe the downside at this point of time is quite limited. Now, the other cases or the other reasons for optimism as per Citi is the ongoing festive season, recent decline in the new COVID cases, and also what they are saying is that while they are quite bullish, and in fact while they have raised their Nifty target, they are also saying that experiences with resurgences in terms of economic activity as well as the movement of people suggest caution. So what they are saying is that policy support as far as India is concerned is quite modest. They believe that there is limited room as far as fiscal policy support is concerned. What they have done, they have raised their overweight as far as financials are concerned, and in fact re-raised it after positive early Q2 earnings. They believe as far as India's earnings is concerned, and this is a very important point, they believe that earnings will trough in FY21 and should bounce back very strongly in FY2022. They are saying that as far as valuations are concerned, not too much valuation. Nifty, as per them, is already trading at 18 times FY22 estimated EPS. That is almost factoring in a 40% year-on-year earnings growth. What they are saying is that as far as India is concerned, the relative valuation versus emerging markets and also the bond yield gap suggests that the market is quite expensive.